Hi stock investors, JJ here. Welcome back. Well, is there a great rotation going on in the stock market right now towards small and mid caps from the mega caps and large caps? It seems to be the case just recently. Let's have a look at the Russell 2000 for the year. It's now up 12.46%, and for the last month, it's up 11.95. So looking at the S&P 500, it's having a good year compared to many, many years. Any year in the stock market, really, 19.49%. But over the past month, only up 3.54. So it seems to be rotating. And if we look at the NASDAQ, for more context, 25.35% for the year. That's a really great year. But over the past month, it's up 3.65. So there does seem to be, so far since the CPI print came out, a rotation going on. Now, this follows on from yesterday, the bull case for small caps with Tom Lee, who's been very bullish. Of course, he likes to predict the market, and they like having him on CNBC to predict. He's predicting 50% rise for small caps throughout the year. It didn't happen for the first half. It was like 3% when the S&P 500 and the NASDAQ was roaring, and now that seems to be changing. Let's see what they've got. I'm going to react to this clip with Anastasia Amoroso, who does think there's a great rotation going on. And then we're going to go to small caps, big gains, and somebody else, another analyst here, saying that the small caps will lead for the second half of the year. We're into the second half now. So anyway, let's get on with it. Let's see what they've got to say, and I'll react to it.
Strategist at iCapital joins me here at Post 9. Great to see you.
Good to see you, Mike.
So I guess on the spectrum of, look, this is a head fake, short squeeze, just a reflex in small caps against large, to this is a genuine tidal change in terms of market leadership and emphasis and the macro message. Where do you come down?
I think this is the great rotation that we've been waiting for all year. And coming into the year, the thesis was that this is likely to be a year of a broader opportunity set and a broader or greater investor optionality for investors, predicated on the fact that the Fed is going to cut rates. Well, here we are. Finally, it looks like the Fed is likely to cut rates, maybe not in July but in September. And that gives not just the sentiment support to some of these trades, but actually the fundamental support to a lot of these trades. You know, why are the small caps rallying? Well, because they do have a lot of leverage, which is hopefully going to reset lower once the Fed cuts rates. Why are the regional banks really rallying? Is because they have a lot of unrealized losses that maybe will turn into not gains, but at least smaller losses if the Fed actually cuts rates. So I think there's something very much real that's happening with this rotation trade.
Okay, so she's definitely think there's a great rotation. There's a few things she mentioned there. You know, the small caps, she said, have more leverage, and it is thought the signal with the CPI going down and Fed Chair Powell starting to make noises about cutting rates. September, remember at the beginning of the year, there was the story that there were going to be 6 or 7 rate cuts. That didn't happen, so it's very difficult to predict. You know, it's people like Tom Lee are trying to predict all the time, even the short term. But it does seem like now that at least one rate cut could be on the cards, but we can get a black swan event out of the blue, so it's very hard to predict that. But immediately when that CPI print came out and people thought that the rate cut is on the way, then the Russell 2000 finally did kind of rocket almost immediately on that news. And that's what she's saying here, that we've been waiting for this kind of thing for the whole year. And I will not mind, as I've said in the last few videos, that my portfolio here, that's not the portfolio. This small and mid-cap portfolio, there's 8 stocks in here, fairly focused, fairly concentrated here. I do have another portfolio with some bigger caps, but also small caps. But this one's up 20.45% for the year, so still doing well against the S&P 500. But if it does rocket for the rest of the year, I will not be unhappy about that. Anyway, let's go back to Anastasia and see what else she's got to say.
I guess the question is, can it remain this perfect in a sense, where you still have the big cap indexes holding up, they're near records, as opposed to it being a little more of a zero-sum game? And I think back to, you know, if you look at the Russell 2000 relative to the S&P or the NASDAQ, right before all this started last week, it was at like a 22, 23-year relative low. Small caps were.
Right.
Okay.
They've had a really tough run. If you go back like 5 years, 46.4224% over the past 5 years is not so great compared to the S&P 500, which is up 90%, but it is catching up now. Even in the last month, if it can hold the gains, it's starting to do, the Russell 2000 small cap starting to do well.
Okay, you go back and look at that 25-year chart, and it blasted off in relative terms. But why? Because big cap growth collapsed in the tech bubble bust in early 2000. So I guess that's the question for me: is in absolute terms, can kind of all boats float, but some some higher than others, or do we have to brace for some chop?
Well, there's some nuances to that. First of all, I do call it a rotation because I do think the time is ripe to take some gains in mega cap tech. And, the catalyst is starting to change a little bit. Why has tech rallied so much this year and last year is because you had tremendous multiple expansion and you also had tremendous earnings, and those earnings were getting marked up. But now, if you look at the levels, if you look at the earnings revisions, for example, they're pretty high for communication services and infotech, and they're low, by the way, for all the other sectors. Valuations, as I mentioned, have expanded, and you had the positive momentum of the economy, but Mike, the economy has been slowing down. The online advertising business is fine, but if the consumer does slow down in the second half of the year, what does that mean for some of those big tech companies? So I do think, just like the right catalysts are emerging for some of the catch-up trades, the catalysts are sort of going the other way around for some of the big tech companies. Now, to answer your other question.
Okay, so she thinks that it's going to be more favorable for the small caps versus those mega caps. And as she mentioned there, the earnings have been good for these companies. I mean, we can definitely say that with NVIDIA, but the multiples have expanded, which she mentioned, from where they were. Other people are saying that they're not super expensive, but definitely the focus is changing. And if it's a rate environment that's more favorable, also that it's almost like there's just more focus on these small and mid caps going forward for the rest of this year. That remains to be seen. As I said, and it's not investment advice in any way. I am invested in small and mid caps, but not investment advice. You need to do your own research, and this a spray and pray kind of approach to small caps is never a good idea. You got to do your work, got to do your analysis, and this is not just a new thing for me. I have been analyzing small caps for quite a long time in small caps, and I'm liking to see this, but people jumping in without knowledge, not a great idea. I do talk about small caps more on Patreon, where from week to week. And so do join us over there if you want to. I'll put a link in the description to that if you want to see more about that. And this stock analysis course, which I've started doing, I'm going to put another one up there soon. I've just started doing that one a week or so. Didn't do one last week, so I can't promise that. But anyway, let's get back to what they're saying here.
And, what does this mean for the aggregate index? I do think that the aggregate index does consolidate and sort of pause from this rip-roaring rally that we had. And the other reason I say that, Mike, is because when you look at what the markets do going into the first rate cut, they rally into it, but then they consolidate and pause and maybe even sell off in the 3 months after that first rate cut. So I suspect we're approaching that moment of consolidation for the broader indices.
Yeah, I've been wondering about that and looking at that history as well. And I mean, first of all, it's hard to characterize what the typical or average response is to the market from a first rate cut, just because the variation is really wide, right? So you have this, the market just levitated in the mid 90s and that soft landing when you got that one. And then, of course, first rate cut in 01 and 08, not so great. And I do also wonder, because this bull market started with the Fed still tightening. Like, I just wonder if the rules are a little bit scrambled right here.
I think that's exactly the right way to think about.
The rules are scrambled. I mean, the thing is, there aren't rules. If there were rules and you could predict what's going to happen, then a lot more people would be very, very wealthy. But you just can't predict the stock market. Warren Buffett, Charlie Munger have said this, Howard Marks. You can take the temperature of the market, but quite often things happen that are unexpected. It can be reversed from the so-called rules. So we just don't know what really was going to happen. It is conjecture here, and she's a strategist, a chief strategist. So it's her job to kind of predict what's going on and strategize for investments. But they can be wrong. They can be so wrong sometimes, but we'll have to see what happens.
about the history, because we can't just look at the median and say, well, this is what this means, because the median includes 2001, 2007, and what you see there is the consolidation that ultimately turned into a downturn, and the defensive really led the way for more than just the 3 months. And on the flip side, if you look at the 1995 and actually a lot of the non-recessionary scenarios, you did have that near-term consolidation, but the uptrend does actually resume about 6 months after the first rate cut. So to me, sort of the playbook for the next, call it into year end, is if we do get a pullback, if we do get some consolidation, you want to use that as a buying opportunity. By the way, there's elections that are coming up, which probably will stoke volatility as well. So if you do hit, some of that downdraft in the fall, I think you want to buy that, because ultimately I'm still in the soft landing camp, and we get rate cuts. That's a pretty bullish scenario for stocks.
Yeah, bullish scenario for stocks at rate cut. Looks like it's going to happen. So we're at the 10-minute mark. I said I'd look at this one here. So do join me if you're interested in this subject more. We're going to get into this into some more. And do subscribe. Do like if you're getting value out of this video so far. And let's see what we've got to say. So small and mid caps will lead second half of the year, says Ryan Detrick here. Let's see what he's got to say.
Oh, I mean, we manage a lot of money at the Carson Group. We've liked small caps for a while now. So it's not like we just are always bullish small caps. Let me be very clear. I love what Mike just said. Just got to add to that. I took a look. I mean, yes, looking at 5 days in a row up 1%. I found Kelly since 1979 11 times. The Russell 2 was up at least 1% every day, 4 days in a row. 1 year later, higher 11 out of 13 times with a 25% average return. Believe me, lots of stuff we can talk about here, but what we've just seen, we think, is kind of that kickoff to what everyone's been coming on your network, including myself, saying more rotation in the small and mid. We think small and mid caps are going to lead the second half of this year, and this is the start of it.
Okay, let's just catch up with what he said there. If you caught that, so 1% for 4 straight days. The Russell 2000's had the small cap index. That's only happened 13 times in history. So the interesting data here. And then 1 year later, the index higher 11 times and up 25% on average. So does that mean that the Russell 2000 small cap index will catch up here over the next half year? We'll have to see. Of course, there's a lot of other things going on and you just can't predict. But let's see what else I got to say.
Do they have the earnings power to justify that kind of leadership?
Yeah, we think they do. I mean, you look at earnings this year, sure, the 600, the S&P 600, like 5%. But you look at next year, it's like 17, 18%, growing more than large caps. Now, listen, those are estimates. We all know estimates, but we're optimistic this economy is going to avoid a recession. Look at today's, the control group on that retail sales number. I mean, the consumer's going nowhere. Consumer's still pretty solid. So we do think those earnings are justifying it. One more comment. You look at valuations, small caps are as cheap as they've been relative to large since 1999. That kicked off a 13-year period of outperformance of small cap. Not calling for something like that, but we think small cap outperformance is here and it's going to stay.
Was it
Well, that's interesting that it has underperformed if we look at those indexes, and I have showed those tables over a longer term. The Russell 2000 small caps have lagged behind. It has to be said that it's just, if you're looking at the index, that's different to looking at individual companies. I'm in favor of looking and analyzing individual companies, not just a spray and pray approach. So I do go into these, as I said on Patreon, I talk about that and look into stock analysis for these companies. They do carry more risks because if it's a spray and pray approach, because there's some, they're not in the S&P 500, which are kind of tested companies, and even then it's a small percentage that actually turn out to be really good investments, really, when you think about it. So you do have to know what you're doing in terms of analysis and picking stocks. Picking stocks is hard to beat the S&P 500 index.
13 years of outperformance they had in the aftermath of the dot-com crash?
It was. And people remember 2000, 2001, 2002. Not a good time for investors. But small caps outperformed significantly. Were they still down? Yes, they were still down. But significant outperformance. So again, and then it lasted a lot longer. But that period in that bear market, small caps can't outperform in a bear market. We're not calling for a bear market. I want to be clear. But last time it was that cheap, small caps did really well.
Well,
that's not commonly known. That's not like common wisdom or knowledge that after the dot-com bubble crash, small caps did relatively well in that big trough after that. So it can happen. It's not as if that can't happen even in a bear market, but we're certainly not in a bear market at the moment. It seems to be broadening out It's not as if the mega caps are actually going down. They're just sort of slowing down.
Well, I guess I would almost flip the question on you and say, if you assume bear market or a certain kinds of, a bubble implosion event, it would seem obvious that maybe not obvious, small caps would outperform. Can they outperform if that doesn't happen? If things just continue along? Obviously, they need kind of broad economic and earnings growth in order to keep doing well. But what exactly are the conditions under which they need to see in order to kind of meet the call that you expect?
Right. One thing we've said all year, we've seen two things we're looking for: inflation getting better and the market to realize it. Clearly, I think we're there after last week's inflation data. And then the economy just hanging in there, coming in, without a recession. Those two tailwinds can be there with the fact that things are historically cheap, with the fact, again, that the Fed, we were always the camp the Fed was going to cut. 2 months ago, nobody said the Fed was going to cut. We thought inflation would come back. It's happening, Kelly. So inflation back, a dovish Fed. They're cheap. They're underloved. They're underappreciated. I mean, 2 weeks ago, last thing here. 2 weeks ago, people were outright saying, why would anybody want to ever own small caps? And it made sense. They underperformed so long. That was the reason you want to own them, because nobody wanted to. That is a peak in pessimism. And now we see what happens with this unwind the last 5 days. One more thing. We released our mid-year outlook exactly a week ago at Carson Group. We said we like small caps. Russell 2 has been up 1% every day since then. So I guess people read it. So thank you.
Okay. So he's picking himself up there in terms of timing, but a few points there that he said that, the conditions seem right, the soft landing in the economy, possibly. I mean, anything can happen. Looks like our interest rates are going to start going down again. Anything can happen. And inflation, being softer. So everything kind of looks like this Goldilocks zone where small caps can rip. But having said that, as he just said, after the dot-com bubble burst, that small caps did well there. So you can't predict, but let's see what happens. I'm keen on small caps, as you know, so I'm keen, and I'm doing more kind of newsy things because I'm posting every day here, so that's why it's more kind of news things like this, following the market and not predicting. This is not investment advice in any way. You need to do your own work, especially when it comes to small caps, well, especially to any individual companies, so keep that in mind. And thanks to everybody for watching or listening to this one. And I will see you in the next one. I'm going to put a link on screen to subscribe if you're not subscribed already, and to a video that YouTube in particular thinks that you should watch next. So go and see that now if you want to. Thanks everybody for watching. I'll see you again.